Let's start with what we learned this week in terms of the inflationary outlook. You say we're going to be on cruise control for a while in some ways, just in terms of tighter monetary policy, in terms of what we're going to see with the stronger dollar. What does that lead you to conclude for investors?
Going forward, we're continuing to recommend that investors focus on more defensive portfolio positioning. So what this means is doing things like adding buffers via core bonds, preparing for more volatility in stocks, and potentially thinking about adding some hedges or using derivatives to take advantage of that volatility and get more favorable return profiles as we continue to wade through this period of uncertainty.
So volatility, but you're not sure which direction, just ride it either way, the wave?
Sure thing. I think we're going to learn a lot coming out of the Fed's meeting next week, and then we get a little bit of a break throughout the month of October until we hear from the Fed again at the beginning of November. And between now and then, I think the market's really going to be swinging on every single data print, particularly as it relates to inflation. And so we've got to be prepared for either, positive responses or potentially more negative responses like what we saw on Tuesday after the release of CPI.
Hey, Diane, you are thinking that even though it's a bear market, there is one area that is really poised to bounce, and that's value. You want to explain a little bit more?
Right. We believe that we are in the early stages of a super value cycle, and it's important to recognize that these companies are poised for growth, looking for company-specific catalysts, and we think that the valuations alone, particularly with rising interest rates, they do much better in that kind of environment.
Where specifically? What types of stocks or sectors are you focusing on?
We've been focusing since the beginning of the year on healthcare as our defensive posture. For many years, they had been under-investing in research and development dollars. If you look back over 10 or 12 years, it had been low, mid-single-digit rates. Over the last 3 or 4 years, research dollars, R&D as a percent of sales, has actually increased to double-digit rates, and revenues follow.
So you think that's about to pay off? They have better pipelines now?
Yes, valuation, meeting innovation, and in particular, it's almost shocking if you've been in the business as long as we have, that the valuations for particularly biotechs are below market levels.
Amgen and Gilead are your favorite names. Why is that?
Well, they have company-specific catalysts in terms of their pipeline unfolding. Gilead really got good news recently when their HIV patents were extended for the next 5 years. They're selling at very attractive multiples. And if you look at Gilead, for example, it's selling at double-digit free cash flow yields.
Elyse, it's been a while since people have liked bonds. We haven't heard many recommendations until very recently when you started to see those yields pick up. Where are you looking in terms of treasuries, in terms of bonds, things that you might like?
Sure. So we are focused on a little bit of barbell exposure, take advantage of higher yields on the short end, particularly through structures like bond ladders, where you don't have to worry so much about interest rate volatility in the meantime. But we have a lot of conviction in longer duration bonds and think that's really important to have in portfolios amidst all of this volatility. I think especially if the Fed comes out and is more aggressive than perhaps what the market has been expecting, we could see more yield curve inversion and maybe a little bit of downside to those longer dated yields on the prospects of higher recession risks. And so we want to have that defensive buffer in portfolios. And, we're looking at investment grade corporates largely steering clear of the high yield space.
And Elyse, when you're looking at equities, you guys are now looking at mid-cap equities. There have been some school of thought that the small companies are going to get more punished by inflation. They have fewer ways to kind of negotiate and get their ways around supply chain issues and other things when it comes to labor. Some people have looked at big companies as an alternative. Why do you like the mid-cap range?
Look, it's not a trade for the faint of heart, but there are really 3 reasons why we like that trade right now. It's valuations, it's the sector and region revenue exposure, and also the performance out potential if and when this cycle finally turns. On valuations, they're down about 25% versus long-term averages. And so even as earnings revisions move lower, we expect that to provide a little bit of buffer. In terms of the sector and region exposure, it's more oriented towards things like financials and industrials, and also, more domestic revenues, which we like, especially amidst the international uncertainty related to the war and what's going on in China. And historically, when we look at how different parts of the market perform once the the cycle turns, you tend to see those smaller cap peers outperform the larger cap peers as they snap back in a faster fashion.